Happy Friday Eve, live from Studio 2 at Bloomberg headquarters in New York. I'm Scarlett Fu.
Don't let her trick you. This is actually her Friday. That's why she's so pumped. I'm Alex Steele, and we're kicking you off to the closing bell right here in the U.S. It feels like the rally is trying to broaden out here. So the stuff that didn't go along with the rally before is now playing a little bit of catch up. The headline S&P goes nowhere, but the Russell 2000, a nice solid rally up by 1.5%. S&P Energy Index, the best performing sector within the S&P, up by 1%. Oil really outperforming as well. And the 30-year had that auction earlier today, $1 billion more than we saw in November. It went down pretty well. Nonetheless, the whole curve is trading a little bit heavy and yields moving a touch higher, but it really does feel like we're trying to get to that everything plus rally, Scar.
We're really trying. All right, Janet Yellen, Alex, sees more turmoil ahead in commercial real estate. And while that may lead to bank stress and financial losses, the Treasury Secretary says she doesn't see the fallout posing a systemic risk to the banking system. Yellen also told Congress that some non-bank mortgage companies may be at risk of failing in stressful market conditions because they lack access to deposits that traditional banks don't. Having said all of that, CEOs are feeling better about the economy overall. The Conference Board's measure of CEO confidence, it rose to a 2-year high thanks to growing expectations for lower interest rates amid slowing inflation. Even so, corporate leaders do worry about the upcoming November elections and the risk of international conflicts worsening. We all do. So you put it all together, U.S. stocks continue to push higher, Alex, setting new records. We see that if it's global stocks as well, because you look at the MSCI World Index, it too is at an all-time high. So it sets up a pretty stark contrast to what's happening elsewhere, particularly China.
Yeah, and for fair point, like you do get to 5,000, round numbers actually mean stuff. You look at your 401ks, you see it on the headline, like that could drive actually more coming into the equity market. As Scarlett was pointing out, this orange line here is the MSCI All-Country Index. So that's everywhere. And you can see that outperformance versus Chinese equities, which is really underperformed. In fact, since its peak that we hit since 2021, Chinese stocks have lost almost $5 trillion in value. However, guys, it's all about tech. So this blue line here is the S&P, outperforming the all-world country index. And then the red line here, well, that's the NASDAQ 100. And you clearly see that the run that we've had over the last 3 years has purely been tech-driven. It doesn't mean you can't have little spots of outperformance here and there. Just take a look at today with the Russell and, say, energy. But still, what's driving the world index is really about U.S. tech, Scarlett.
All right, that's a great way to start off our conversation with Bob Elliott. He is CEO and CIO over at Unlimited. And Alex says it's all about tech. Maybe they should be their own index. And, you know, the Magnificent Seven, it pretty much is. And then you look at all the other national markets, whether it's the U.S., whether it's China, whether it's anything else. You take out U.S. tech, how attractive is the U.S. market and the U.S. economy to the rest of the investing world?
Well, I think what the mega tech stocks really are highlighting is the cyclical strength of the economy. When you actually break these stocks down, what are they really? Amazon is consumer sales and business investment. Google is advertising. Meta is advertising. And so I think what they're really showing is that in aggregate, the U.S. economy, nominal GDP growth, it's very strong. It continues, and they just have some of the highest betas and best cash flows to that strength in the overall economy. So when you look to the rest of the overall market, what you see is companies that maybe aren't quite as strong and are more sensitive to the liquidity conditions that are going on. But those companies have a chance to rally in these sort of environments as liquidity starts to ease a little bit, the Fed shifts their policy stance, and GDP growth continues to expand.
So is that a buy small caps?
That's right. I mean, you could easily get a rotation here into the small caps.
But will it last? I mean, we saw this trap last year. It did not last.
Well, I think the main reason why it didn't last was the real question was whether monetary policy was going to continue to be tight. And whether that tightness of monetary policy and the difficult of financing conditions was going to keep weighing on those companies that needed the ongoing financing. We're shifting to almost a perfect situation for many of those companies where the economy is good, but we're shifting to an easing cycle with low valuations. You put that all together, if people are looking for corners of the market that haven't been bid up nearly as much, they're going to look to those areas like energy and small caps.
All right, let's fold fixed income into this conversation as well. Alex was talking about the 30-year Treasury auction. Pretty good demand for the 10-year auction as well. So February looking okay when it comes to the Treasury refunding itself. What is your read here on the supply that we're going to get this year and whether that demand will continue to show up?
Well, those 30 years that got issued earlier this afternoon are now, through the bottoms. And so we're seeing yields rising. We're seeing that creeping happening for many of those buyers that are continuing to experience losses. We moved from well under 4 in now, up to 415 on 10s. And I think the key thing to remember with the bond issuance dynamic is that it's going to be very hard to front run $500 billion of net new supply in quarter 2. And so it's every day what you're seeing is a weight on the bond market that's coming as that issuance comes. And remember that Q2 net issuance is going to be twice as big as Q1. So right now, the actual flow, the actual demand to borrow is not that bad. Just wait till Q2 when it doubles in size on net.
Sure, but we could have said that like in the fourth quarter of last year, and then the takedown actually went okay. What do you do in a market, though, where you come in every day and things look overbought, technicals do not look good, and yet we continue to grind higher? Like, how do you manage that?
Well, I think you got to look at the linkages that will either stop the economy in its tracks or keep it going. And we've got this income-fueled expansion, and in that environment, stocks can continue to outperform, particularly bonds, as income growth continues to finance spending, and we continue to get strong nominal GDP growth. That's a very resilient type of growth. This is not the debt-fueled growth of cycles past. This is a expansion that can continue for an extended period of time until we get enough tightening in the financial markets to start to bring down asset prices and slow the overall economy. So right now we're really in that sweet spot of strong enough growth without enough tightening, particularly on the long end of the bond market, to bring things back.
How high do yields have to go before you start to see it show up in equities in a bad way?
Well, I think we saw a little bit of a flavor of that last year, but we moved bond yields up to 5, and equities sold off, 10%, 15%. That's not that big a deal. Equities sell off 10 or 15% all the time. And so we're probably going to need to get bond yields up there and for an extended period of time before there's enough of a weight on asset prices in the real economy to really bring this expansion to a halt.
All right, Bob, really appreciate your joining us today. Bob Elliott is CEO and CIO at Unlimited. We've got a lot more coming up on the close. Coming up, shares of ARM surging the most since its IPO after giving a strong sales outlook. The stock getting an upgrade as it pushes beyond smartphone chips. That's in our top calls.
Plus, we're going to hear from my conversation with Lynn Good, the CEO of the power company. It's a big, huge utility, Duke Energy. Her take on the U.S. energy transition as demand for electricity skyrockets.
And we'll focus on potential opportunities right now in commercial real estate. In spite of all the market turmoil, our guest, Anton Pill, Global Head of Alternatives at JP Morgan Asset Management. This is The Close.
Shares of Duke Energy, the worst performer within the S&P utilities sector. That's after mixed results this morning. Despite the share move, though, CEO Lynn Good is remaining confident on future growth.
We are seeing a level of growth that we haven't seen in decades. And a couple of things I would point to. It's population migration that continues really from the pandemic forward. But adding to that is extraordinary economic development growth in all of our service territories. So think about onshoring U.S. manufacturing, semiconductors, battery, automotive. And as the U.S. continues to pursue leadership in artificial intelligence, it's data centers. And so all of that growth gives us an opportunity to continue capital investment at a pace that not only serves customers, but delivers returns to investors.
So your 5-year CapEx plan was updated by $8 billion to $73 billion. What is your level of confidence that you won't have to revise that up again?
It's a good question, Alex, because I believe the capital plans will continue to be refined. You might, in following us, know that we do have generation plans in front of our commissions in North and South Carolina, as well as in front of Indiana, where they'll be working with us on the pace and the type of generation investment, in addition to all of the grid investment that's underway. So I believe those capital plans will continue to be refined. I would say the bias would be to the upside because of the growth potential, but pursuing it in a disciplined way that keeps an eye on the reliability and affordability is another important point that I would just underscore. We have to do all of those things right.
Managing this surge in demand is going to be huge. Do you think that we're going to see slower closure of coal plants because of that?
It's an interesting question because it has to do with, are we going to be able to bring resources onto the system at the right pace to meet the demand? And right now, we remain committed to reliably closing coal in 2035 and are bringing a wealth of resources, solar and battery. We're taking advantage of energy efficiency, demand side management, some natural gas, and continuing to pursue new nuclear as well, small modular reactors in the mid-2030s. And I think, Alex, if we can keep this diverse set of resources moving, it will allow us to continue to target reliably retiring coal in 2035.
What is the conversation around a new natural gas plant in the boardroom right now? It feels like that's a very tough subject. And putting money into something that's going to be there for the next 40 years goes in the face of sort of climate neutral or going green for the United States. Like, what do you guys talk about in relation to natural gas?
Our assignment, Alex, is a threefold assignment: reliability, affordability, and increasingly clean. And I think the question you're really raising, and the question that's in the Duke boardroom, is it wise to invest in natural gas? Is it wise for our customers, for our communities, for our investors? And I think this context of growth has to be a part of that conversation, because we need to serve the growth. We need to balance the short term with the long term. And so where we come out is a diverse set of resources is going to be necessary. We're going to need to lean on some existing technologies while we're also exploring hydrogen, carbon capture, new nuclear, offshore wind, and technologies that'll be maturing into the 2030s. So we continue to believe that natural gas represents a clean form of generation, complementary to renewables, important as we retire coal. And we also believe that as hydrogen develops, it'll be a continuing clean source of generation for years to come.
In the meantime, we were mentioning the demand side. Have you had to turn away any big customers because you just don't have the capacity yet?
We haven't faced that yet, Alex, but we watch it really closely. As you can imagine, economic development in all of our states is a partnership with the states. We're working closely with economic development organizations, with commerce organizations, and really working to market our states in a way that achieves their objectives of job creation and economic growth, while also making sure that we have the resources to serve.
Do you expect that you'll have to have those conversations at some point?
You know, I don't foresee it in the near term, Alex, but that's the conversation that's ongoing in front of our regulatory commissions right now. In North Carolina, we filed a generation plan in August of this year, and we've already updated it, filing it again in January of this year with more load growth, with more need for generation. And I think it's just an important conversation that we're going to have in all of our states.
Just
how to find the
You have to find the happy balance. So then to flip it, are you seeing industrial customers that want to go into your territory, that are looking to build factories, that they say, ooh, you know what, Lynn, I got to get back to you. I don't know if I can actually get this done because of the power?
I haven't heard that, Alex.
Okay.
You know, the conversation with industrial customers is a broad-ranging conversation. They're looking for workforce. They're looking for supply chain. They're looking for sources of energy. They're looking for a state that they can partner with that has fiscal policies that meet their needs and expectations. And North Carolina, as you know, has been ranked #1 for business for a couple of years running. So that conversation around economic development has been well seated. And we expect those conversations in all of our territories to continue.
What about in a Trump presidency? And I say that because you were mentioning the CHIPS Act, you get the IRA and the Infrastructure Act. Is there a conversation that any of that will be repealed if you get Trump back in the White House, and sort of what that does to the demand side of your business?
I'm not going to speculate on the politics, Alice, because frankly, I don't know. But I would say when we think about politics and we think about how it impacts our business and it impacts the communities that we serve, our objective is to be advocating for policies that support where our states are trying to go, what our customers need, what we need in our business in order to continue to serve. And what we find is in a bipartisan way, there's a strong interest in infrastructure in making sure that the U.S. remains globally competitive, that we onshore these industries in a way that strengthens us, not only economically, but from a national security standpoint. And then any way that we can lower the price of energy to further underscore that that economic competitiveness is also something that's a part of the conversation. So infrastructure and low energy prices, I think that's a combination that enjoys a lot of support in the political arena.
That was Lynn Good, Chair, President, and CEO of Duke Energy. So a couple things. There's the demand side. They got to spend more money. How do they wind up financing the money? The balance sheet's looking much better, but still, that's the risk. But on that net, like all of these changes about Infrastructure Act, CHIPS Act, IRA, huge monumental changes for these companies.
She's the perfect example of one of those CEOs who are feeling better overall about the economy, a little more confident, but at the same time kind of concerned about what's to come in November with the election changing up a lot of those things like the IRA, which sounds like it's been good for Duke.
Yeah, because you can definitely get some upside for tax credits and hydrogen, for example, or nuclear. They have a ton of nuclear storage as well as renewables. So you can get that. But also, if you want to build an EV plant in the Carolinas, you're going to be plugging into Duke.
Yeah.
And that's just going to really help the demand side of it. But again, then you got to spend the money. So, and also a lot of these companies are already sinking their cash. Like, it's going to be really hard to roll back some of the CHIP and Infrastructure Act stuff, even if President Trump goes back to office, because it's already sunk. It's already there. You're already planning it.
Right. Well, can't reverse that. That money's already been earmarked.
Yeah. All right. Coming up, ARM shares are skyrocketing here. That's after impressing some analysts with its sales and profit outlook. We're going to recap the earnings. And first, CEO Renee Haas tells Bloomberg how artificial intelligence is, shocker, driving the upside. This is The Close on Bloomberg.
What designers want to do and need to do is future-proof their designs with more and more compute. And that is really driving a strong licensing cycle for us in terms of more demand.
It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And we start with Spirit AeroSystems, an upgrade to outperform from market perform at Cowen on hopes of a rebound in free cash flow. The aerospace manufacturer increasing volume and productivity, and once contract talks with Airbus are settled, the analyst says its cash position should improve in the second half of the year. The shares are up by 0.2%. Next in line is Hertz. Morgan Stanley hitting the brakes on the rental car company with an equal weight rating about 3 weeks after it had upgraded Hertz to overweight. Analyst Adam Jonas warning investors about the risks facing its EV strategy. Jonas says shrinking the fleet is an important first step, but more needs to be done. Shares right now down about 1%. And finally, ARM's price target lifted to $115 at Citi, up from 86, and Citi keeps a buy rating on the stock. Analyst Andrew Gardner was impressed with the latest earnings report, with royalties and licensing driving the upside. He sees sales trends remaining robust into fiscal 2025. The shares right now up almost 50% on the day. And those are some of our top calls. So joining us now is the analyst behind that call, Andrew Gardner. He's staying up late for us. He is head of European Technology Equity Research at Citi. Andrew, thank you so much for staying up to speak with us. ARM, as you noted in your recent research report, delivered an impressive beat and raise, but a 50% jump in stock price. Does that get it to a point where it gets a little expensive?
ARM has long traded at a premium multiple. I suppose it's one of those stocks that's got a very strong structural story, both at the top line in terms of the revenue growth that's happening today, as well as into the future. And it's got a very strong operating margin profile, again, something that's likely to expand nicely into the future. So yes, it does trade on a premium multiple, but I would say it's very much justified given those strong fundamentals.
Andrew, do you feel like the valuation that you've now put on it incorporates licensing and royalties at a certain point? Like, what credit is ARM getting for which right now?
I think the market is looking initially at the near-term royalties. That represents the chips that are being delivered at the moment. They did see upside there in the quarter, but really the impressive upside in the December quarter came from the licensing side. And that, as you'd heard earlier from Renee Haas, the CEO, has really been driven by increased need for ARM's designs as their customers look to do more in the area of artificial intelligence. And, I think, again, as the company has laid out, and I would agree, we're very much in the early innings of artificial intelligence adoption. This is something that Arm's customers are taking technology from Arm today. They're going to go away, they're going to design those chips, and you're going to see more come from them over the next 3, 4, 5 years. It's a very long lead time item that they are licensing out to the customer base. So that is really what is supporting such strong long-term growth into the future.
Long-term growth, we know that the trend line is going up for the next 3, 4, 5 years, but how do you begin to model that out year over year? When you actually put numbers to that, what does it look like, or what are the challenges of doing that?
Yeah, I suppose it's twofold. On the royalty side, it's perhaps a little bit easier because that's happening here and now. And we can try and get an estimate as to what's happening in the mobile phone market, which is a third of Arm's business at the moment. Used to be much higher. It's come down as they've diversified, but it's still the biggest single driver. And we've got estimates of what the mobile phone market is doing. They're gaining share into the infrastructure space. So you're seeing more cloud computing companies adopt ARM-based designs. Automotive is another big growth driver into the future as our cars become more intelligent over time. So we can look at those end markets and try and think about the unit volume and the rate of ARM adoption and the pricing of ARM's technology. So that side of it, we've got the variables there to play with and make forecasts. The licensing side of things is a little bit trickier. It can be quite lumpy, quarter to quarter or even year to year. It very much depends on when those big chip customers come to Arm and say, right, we're ready for the next slug of technology from you guys. We're looking further out into the future, but we need this architecture today in order to design those chips. So that's a little bit trickier. We do take some guidance from the company in terms of how to model that. The royalty side is a little bit more predictable.
Quickly here, Andrew. The stock is at 114, 113. We're like kissing your upgrade that you just gave today. How quickly are you going to have to be rethinking the stock and modeling it out?
No question, it's a fast-moving name, and I think the surprise that we've had today, particularly on the artificial intelligence front, is where everyone is going to have to go back and do a bit more work and really see how Arm's technology is going to be adopted further into the future. Again, the company with the results for the December quarter last night gave us some initial idea there, but we're in the early stages here. So I think there's more to come from Arm.
Yeah.
They've certainly promised us a bit more of an update in 3 months as they themselves go away and reassess things.
Andrew, really appreciate it. Thank you so much for staying up. We really appreciate that. Andrew Gardner over at Citi. But point blank, when you have a $120 billion company that's moving 50% on solid numbers, that's an incredible move. How often can it continue to do that?
Remember when people were worried that ARM was too reliant on Apple? That's gone away now.
That is just dead in the water.
Two letters, AI.
Yeah,
right?
exactly.
Changed
All right,
everything.
next up we're going to talk to Anton Pill, Global Head of Alternatives over at JP Morgan Asset Management. This is Bloomberg.
Just about 3:30 in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. Can we just get this headline here? Money market funds reach a record again of over $6 trillion after we have been pricing back some of the Fed rate cuts. We talk about that money moving out and where that money belongs to. That money likes where it is.
Yeah, it's pretty happy. It's earning a pretty good yield.
You
it
count
continues
those zeros?
to do so.
I can't count those zeros.
How many is that? 12?
1, 2, 3, 4, 5, 6, 7, 8. Yeah, 12.
That's 12
That's
zeros.
a lot of zeros.
And a lot of commas on top of that. Yeah, the big question is that dry powder for something?
Yes, but when and where?
And it hasn't happened yet.
No, and we're waiting for that moment to happen. Where it's definitely not going is New York Community Bank. How's that segue for you?
That is a great one.
Thank you. Shares are down yet another 7% today. Remember, the stock has lost more than half of its value since late January when it took losses and provisions against real estate loans that were more than 10 times bigger than analysts had anticipated. And commercial real estate is a risk for all types of lenders. We saw some property guys over in Germany get hit. Earlier today, Treasury Secretary Janet Yellen did highlight these additional risks stemming from non-bank mortgage lenders.
FSOC is very focused on that because non-bank mortgage companies lack access to deposits which banks have. There is concern that in stressful market conditions, we could see the failure of one of these.
For more insight, I want to bring in Anton Pill, Global Head of Alternatives over at JP Morgan Asset Management, where alternatives is going to be key for you.
Yeah, I know where you can put some of that money.
Oh, you know,
There we go.
I bet you can. But when you say alternatives, what is it? I mean, is it private credit? Is it these non-bank lenders that Janet Yellen is worried about? Is it gold under my bed? What is it?
It's a little bit of all of the above. We tend to think of it in sort of two concepts. Obviously, private assets, which are anything that is not traded publicly, but also non-index-based long-short managers, hedge funds, things where you can go long and short, which is a little bit different. It's a different set of tools. So that's kind of how we think about alternatives. It's not your traditional bond market. It's not your traditional stock market. It is effectively asset class that can help diversify your overall portfolio.
It can help diversify your overall portfolio, and it's certainly a lot more accessible now than it had been in years past. But what is the take-up by investors, particularly retail investors who are sitting pretty happily with their passive funds just following the S&P 500?
Yeah, look, that might have been a great trade in 2023. I don't remember a lot of people being that excited in 2022 when, for example, alternatives actually had a very strong year. I think what alternatives can do is help smooth the ride, including for individuals, of their actual portfolio performance. And frankly, when we think of some of the uncertainty in the marketplace right now, for example, many people are constantly debating, when is the Fed going to cut rates? Are they cutting rates? When is it going to happen? That's all resulting in more volatility in both equities and fixed income, which really, as a long-term investor, you're not really enjoying that ride. I think alternatives can really help smooth that and keep people invested longer term for their eventual wealth buildup.
So we just take the private credit world for a second.
Yep.
I feel like there's two schools of thought. One is like, guys, we have no idea what all this money going to private credit is going to do if there's a massive downturn. It's hard to price these things. And then the other is like, hey, yeah, but your money's locked up for 10 years. There's a long time horizon. Like, it's going to be okay. Which camp are you? Okay, you're going to be in the first camp. But why are you in the first
actually,
camp?
I'm a little bit more, I'm probably out of all the sort of alternative asset classes, private credit is the one I'm probably most cautious about. Really? Not so much because of bad covenants or of the lending standards, but frankly because valuations there have started converging more closely to high yield. And I think in an environment where you're uncertain and have a lot of volatility, I think on the margin I would probably make sure that the private credit you own is extremely high quality. And if you want to own something a little weaker, go into the high yield market where you'll have some degree of liquidity. Not that popular of a view amongst many peers of mine, but I do think valuation plays a big role. Now, you are correct. Having a long-term hold period allows you to ride out a lot more uncertainty and actually allows you to negotiate with these companies to help think about how they survive through a liquidity squeeze. The flip side is, if the Fed does cut rates, liquidity is injected back in the marketplace, most of these asset classes will do quite well, including private credit.
We were talking a little bit earlier about your biography and how you started off in the public markets, fixed income, currencies, commodities, equities as well, and then you've transitioned since then to alternative assets and alternative investments. Is the industry made up of people like you or those who started off in alternative investments and therefore don't really have the scope of understanding markets as a whole?
I think it's a combination of both. I think some people really grew up in the private equity business and have been in that sort of trend for a while. Others, similar to myself, started in public markets and started realizing the growth of private markets and therefore are looking at private markets as being sort of the next opportunity where you can apply the learnings from public markets. And as private credit continues to grow and private equity continues to grow, these markets are beginning to be equal or larger in size than the public market. So expect that that trend to continue.
What has surprised you the most about making that transition into alternative investments from the public markets?
I think many public market investors are sometimes a little annoyed that we have a much longer time horizon. I don't have to worry about like earnings this second right now because I have a much longer time horizon. And I think for a lot of investors, that can be particularly powerful for their portfolio. They can kind of not get scared when something bad happens overnight and then 3-4 weeks later not worry about it.
So how worried would someone who has a long time horizon be about the commercial real estate wobbliness that we're seeing right now?
So, I actually have a little bit of a different view than most. I think we're beginning to bottom on the sectors actually that most people are worried about. I think on the office side, we're beginning to see a lot more people go into the office. If you look at how stuffed people are in an office, especially in the US, lot of people probably were going to need more office space if the growth in the U.S. continues. So I think a lot of it is if you can buy high-quality office that's fully leased, the values are there, and you're probably going to bottom out by the end of the year, early next year. So I'm actually more optimistic on the commercial real estate side than most.
What about residential real estate? Because in some ways, I mean, that was really New York Community Bank. That was the tough one, right?
Right.
In terms of the rent-controlled building in New York.
I think that's right, and I think some of the segments in real estate that people are most excited about, which are multifamily, I actually think could be on the verge of a much more difficult second half of the year because of an oversupply of that's coming in the marketplace.
I also wanted to get your thoughts on private equity before we let you go, because it's sort of the similar story with private credit in terms of the time horizon, et cetera. But what we've seen in the last few years is the lack of exit strategy and the creative ways where you have to fund yourself where you can't exit. What do you think of that as an investment now?
I actually think it's going to be a very good vintage year for private equity. We've seen valuations come off in 2023 from some of the highs. And frankly, a lot of the people who needed that liquidity that you just described are being forced sellers. And if you can pick that up, and even for individual investors who can get access to products that are buying these in the secondary market, someone else's, and providing liquidity, I think it's actually going to turn out to be a very good year looking back.
You say for private equity on the buyout side, there are certain areas that are more attractive than others, mid-market, small market in particular. But I look at, for instance, the Russell 2000 and how it hasn't had that breakout. I mean, we had a couple of head fakes.
It tries.
We've had basically
many of these companies are staying private much longer. That's part of the problem.
Exactly. Talk us through why you see value in small caps when public market investors can't seem to find it.
Yeah, I think partially because at the end of the day, when you're doing a small and mid-sized company, it's not about the financial leverage to try to get your return. You're actually going to manage that company to try to improve the company itself. So it's much more about managing the nuts and bolts of day-to-day activity than trying to bet on whether rates are higher or lower in your next refinancing wave. And that's what's exciting. Like on the small and mid-cap size, we can see the real-time impact of things we're doing on these companies and the value you're generating by managing them well, which is a lot harder to do on bigger companies, which are much more dependent on financial leverage.
Anton, really great. We really enjoyed talking to you, Anton.
It's great to be here, guys.
Come back.
Thank you.
Global head, and you're contrarian. We like that. Global head of alternatives at JP Morgan Asset Management. Some breaking news for those of you who follow oil, like I do. ExxonMobil is now exiting Equatorial Guinea within months. They've been there for 30 years, well, almost 30 years. They have helped transform this nation into one of OPEC's smallest members. What this tells me, Scarlett, is that this is Exxon continuing to trim any fat that they have to pour all of their focus and resources on the Permian, for example, integrating Pioneer and really helping to streamline what they are able to accomplish.
Is this a call on Equatorial Guinea, or is this more just the Permian Basin is just so attractive, we want to place all our bets there?
I would say something probably in the middle, that they probably can't bring any more value to Guinea. I mean, they're probably up and running, and their technology, et cetera, maybe won't be useful there. They can apply their technology in a big, big way, say to Pioneer's wells, for example, or to other assets that they have, probably not this asset.
So it's Exxon making a call, essentially.
I mean, I think, but
All right. Oh, well, something we'll watch for. ExxonMobil currently up about $1.93 at 104.15. All right, let's talk about our stock of the hour because it is coming up. It is a Chinese holographic tech company really capturing the attention of meme stock traders. Look at that move today, up 45%. This is the close on Bloomberg. It's time now for our stock of the hour, and today we're looking at a battered Chinese company that develops holographic technology. The name of the company is Microcloud Hologram, and the shares are soaring today after garnering attention from who else? The meme stock crowd. Elena Popina is here with us now. Over the last 2 days, it's gained 1,800%. That boggles the mind, Elena. And the ticker is HOLO, H-O-L-O?
Exactly. HOLO is very similar to YOLO, which stands for you only live once. So this stock closed at an all-time low on Tuesday. It rallied tenfold on Wednesday, another 100% early in the day on Thursday on no apparent reason. It's just that, the meme stock crowd decided to push it higher, as was the case in 2021. But guess what? Options on this stock are not trading, so it's not call options that are driving it so much higher. It's just the shares that are rallying so much. No bad news.
So is this like a risk appetite among retail guys up again? Like, is this going to be 2021 all over again?
Yeah, it seems so. It's one of those tickers that was trading near $1 a share, which is very close to the mark where it gets kicked out of official stock exchanges and goes to the OTC market. That's why it did a reverse stock split. But yeah, it could rally some more based on the appetite of the mid crowd.
Okay, so you and your colleagues on Bloomberg's cross-asset team and stocks team, you are trying to talk to analysts and investors who actually cover this company. Are you able to find anyone who can tell you anything fundamental about this company?
Nothing fundamental. Yeah, it was an absolutely penny stock company. It did a reverse split on Friday. It went public in 2022. It wasn't doing really well. It is a Chinese-based stock that had no coverage on Wall Street, no apparent value that would take it so much higher in such a short period of time.
And this is why David Einhorn gets mad. This makes sense, right? Okay, Elena, thanks a lot. Elena Popina joining us from Bloomberg. All right, coming up, we are still on earnings watch. We get Affirm, remember the buy now, pay later company. We got Pinterest. We got Take-Two out with results after the bell. We're going to break down on what to watch with Dan Suzuki. He's deputy CIO over at Richard Bernstein Advisors. You are watching the close on Bloomberg. Volume not that exciting. Overall index level not that exciting, but you're still seeing the Russell do pretty well. You're also seeing sort of the unloved stuff like energy do well. So it does feel like, at least today, the rally is broadening out.
Yeah, the Russell 2000 having an impressive rally on a day in which not much else is happening. We are hugging record highs, though.
5,000, it's a round number.
This is the countdown to the close. I'm Scarlett Fu here with Alex Steele. Alex, not a whole lot to look at if you're paying attention to the S&P 500, which most people are because they're invested in some kind of index fund, but a lot to get excited about, I guess, if you like small caps.
Well, at least today.
Yeah.
I mean, the Russell doing quite well today, up about 1.5%. Energy, as I was mentioning earlier, also up, so doing well, over 1%. I just want to point out a winner and a loser, just because they're fun to talk about. So one loser was PayPal. We had them report yesterday after the bell, the worst performing stock in the S&P, cutting costs, streamlining operations. Usually that gets investors excited, just not so much with this stock. And then Ralph Lauren totally missed this one, up 17%. I was interested by the strong rebound in China, which totally flies in the face of things like Estee Lauder and L'Oreal. I realize that's skincare, but that did not, that labeled China as the reason why their earnings weren't as good. But Ralph Lauren just totally defying that expectation.
The Chinese consumer really likes the preppy look, I guess.
Yeah, I really,
right?
Sure.
I mean,
yeah, I don't know.
Ralph Lauren's styles are pretty consistent. It's always within that preppy school. All right, let's talk about earnings season so far because they're rolling on. And after the close, we're going to get Affirm, Pinterest, Cloudflare, try saying that quickly, out after the bell. Our next guest expects earnings to, quote, continue to accelerate for at least a couple more quarters, adding that he likes companies least priced to benefit from that acceleration, such as small caps, industrials, and emerging markets. Dan Suzuki, Deputy CIO over at Richard Bernstein Advisors, joins us for more. Small caps, we keep talking about them and we keep hoping that they'll actually be able to hold on to some of their gains, but it doesn't come. I mean, there's so many fleeting advances. What's different this time?
Well, I think to some extent that makes sense. I mean, if you look at the underlying, you look under the hood at earnings, it has been a tech-driven story up until now. But if you look at the acceleration that analysts forecast for the rest of the year, that's going to be less and less the case. So you're going to see, the further acceleration of earnings is going to be less about tech and those related sectors growing. They're actually going to be growing at a slower pace, and it's going to be more the traditional cyclical areas of the market, like small caps, like industrials, like energy, whose earnings are expected to accelerate, if you believe the analyst forecast.
You do?
Yes.
So why is this time different than like last year, which was like a fake out?
Well, last year we were in a profits recession for the first part of it, and then as you accelerated, it really truly was, the tech stocks who led us into the earnings recession, which had big bounces coming out of that. So to some extent, it makes sense that people are getting excited about that, turnaround in growth.
We try to get excited all the time about these other companies, anything beyond the Magnificent Seven, but it doesn't work. And in the end, everyone just looks at the same seven stocks, maybe not Tesla so much, and piles into those. I mean, we talk about the broadening of the rally. It hasn't happened.
I know, and you talk about broadening, like maybe if the gap was this big and it goes to this big, I guess it broadened. But still, I mean, Dan, why do I want to buy small caps when I just need to go buy the Mag 7?
Well, there's two things going on, right? I mean, we've been talking for a long time about the dominance of the Magnificent Seven, but this year, every time I turn on the TV, it's like the Super Six and the Fab Five and the Fantastic Four. I mean, at some point, maybe you are just getting implicit broadening out here when it's less and less stocks that are driving the market higher. But I think the other thing is, if you look at the history of markets, you don't have sustainable markets, long-lasting bull markets that don't at some point come with breadth. I mean, we saw last year was the worst breadth basically in history. And I don't think that that's going to continue. If it does continue, it's probably a very bearish sign for markets than a bullish one. Because if you think about it, it's okay to huddle up in the handful of stocks that have the best growth when there's not much growth out there. Mm-hmm. But the more the profits accelerate, the more companies can put up really strong growth, and then you can become comparison shoppers and say, well, why would I pay 30 or 40 times for a stock growing at 20% when I can pay 10 times for a stock that's growing faster than that?
We were just talking about a headline earlier about money market assets hitting a record $6.02 trillion. That was 12 zeros, we counted, after the Fed cut pushback, after it became apparent that the Fed was not going to cut rates in March. Is any of that money being deployed right now? What are you seeing?
It looks like it's being deployed, but it's being deployed very narrowly. I mean, if you look at the sector flows year to date, I mean, there's one sector that's got all the flows and everything else is basically flat to down. So, and actually what's also interesting is you're seeing people focus less on buying broad market indices. Mm-hmm. That's yesterday's story. You can just go buy the 3 or 5, 7 stocks that are driving anything. So people are actually just back to stock picking now, and not really picking, they're just buying those 7 stocks.
So let's go into the Russell for a second. Would you sort of use the same template that some are doing with the Mag 7, but use it in the Russell? So is it a value versus growth situation within the Russell? Do you need to buy Russell growth rather than value? Or you break the value?
No, I think historically, the time to own growth is when growth is weakening and slow. Well, that's not the case. If growth is going to continue to accelerate, this is actually a better time to own value. And so owning value, owning cyclicality is the right thing to do while this earnings recovery lasts. Now, I could come back here 6 months from now and very well be seeing signs that the profit cycle is starting to roll over. If that's the case, you're probably going to reverse that trade and maybe add more growth back into the portfolio. But I just don't think this is the time when profits are actually still accelerating.
I want you to weigh in on the other big story that's really been plaguing investors the last few weeks, and that is, of course, commercial real estate and your community bank and what that says about the bad loans out there and who that's going to hit. Because we've seen a German bank bond get affected. We've seen Japanese companies get affected. How worried are you about commercial real estate rearing its ugly head again?
I think you have to be aware of what your exposures are, right? I think that the fact that everybody's talking about it and it's all over the headlines and banks are failing over, I think, to some extent that should give you comfort that a lot of the bad news is priced in, but there's still going to be, you should never be surprised when there's a handful of companies that are going to be taken down by this. That's just the history of how things go. It doesn't mean that it's going to be this worsening crisis from here. In fact, I'd say in many cases, a lot of the bad news is priced.
When do you think we start to get an earnings rollover again?
A lot of people, probably maybe most of the people that come on this show will proclaim to be able to see the future. We really don't try to make that proclamation. What we try to tell people is the second best thing to that is actually being timely in identifying the inflection points. And for the time being, we're not seeing any signs of inflection. In fact, actually things are still getting stronger from an earnings perspective. But again, we have visibility a couple quarters out. So as we get into third, fourth quarter, who knows what's going to be happening? There's going to be a lot going on at that point in time.
What are you most worried about right now, very quickly? What weighs on your mind?
Well, at the risk of sounding like a broken record, I think there's massive concentration risk in the markets today. And so it doesn't take a whole lot for the wind to come out of those sails at any moment.
All right, Dan Suzuki, really appreciate it. Deputy CIO over at Richard Bernstein Advisors. He's worried about something that we've talked about for so long, over-concentration risk, but still has not yet really come to fruition.
No, and also just the idea that just because you think this now doesn't mean that in 6 months you won't change your view, right? It's a fluid market, so fluid opinion.
All right, we're moving closer to the closing bell. Full market coverage right here on Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
We're about 2 minutes away from the end of the trading day. I'm Scarlett Fu here with Alex Steele. We're counting you down to the closing bell. And here to help us take you beyond the bell with the global simulcast, Carol Masser and Tim Stanovic. And of course, welcome to our Bloomberg Television, Bloomberg Radio, and YouTube audiences who are joining us online to take a look at this trading day, which by the measures of the S&P 500, we're not seeing a whole lot of action, but we're near record highs, and the Russell 2000 finally gets a bit of a pickup.
Which is good to see, right? Those small caps participating. But yeah, I keep calling it a meh day again. But 4999.68, right, is what we got on the S&P. So so close to 5,000. Charlie Pellet and I, like all of us, we've been kind of obsessed watching whether or not we get above 5,000 here.
The indices, though, they're masking the big moves that we're seeing in individual equities today. And look at Alex, what ARM is doing today, up more than 60% at one point in the day. Disney higher by double digits. We're seeing PayPal down by double digits. So we're not getting the real story by looking at the indices.
No, and particularly with ARM too. I was mentioning this earlier. That's a $120 billion company, right? And it's moving by this much. That's quite amazing. A lot of churn within the equity market. But I'm still into the small cap story, the energy story, like the laggards over the last few weeks playing a little bit of catch up. Will there be follow through tomorrow? I don't know. I'm more skeptical.
We do get a CPI print. You do wonder if it'll change, if anything, kind of the
revisions.
Tone. Yeah, and revisions,
which,
right.
Could hold a lot of change. It's worth noting as well, we had a pretty decent 30-year Treasury auction following a decent 10-year Treasury auction.
Now you like the auctions. Well, she was making fun of me yesterday for the auctions.
Why was she? Wait, what's going on here?
I wasn't making fun of her so much as saying, you really want to talk that long about the auction?
We have to separate you two.
We did the top of our show with Michael McKenzie on the auction yesterday.
Oh, okay. I see.
It was must watch.
All right, let's take a look at how markets are closing on the day. You have green all around, but did we get to that 5,000 level? No. 4998.52 is the early read, but of course we're waiting for it to settle. We're going to come shy of that 5,000 level. It is a gain of almost 0.1%. Dow Industrials adding about the same amount, and Nasdaq gaining 0.25%.
All right, folks, let's get to some earnings crossing the Bloomberg terminal. We're talking about Expedia, home to so many travel websites. Man, getting killed in the aftermarket, down about 8.5%. Let's go to the numbers. Fourth quarter revenue, 2.89 billion, slightly higher than the street estimate of 2.88 billion. Fourth quarter adjusted EPS $1.72. That's 3 pennies better than the street was expecting. Fourth quarter negative free cash flow $415 million. The estimate was for a negative $192.6 million. So that's going to disappoint investors. Fourth quarter gross bookings $21.67 billion. And Tim, that's also coming in light. $22 billion was the estimate. Stock down about 7.8% here.
Yeah, Peter Kern, the vice chairman and CEO of Expedia, saying our work is finally starting to deliver results and we are in the best place we've ever been technologically. Moving forward, we are now able to execute without the numerous constraints we have faced in recent years. We will continue to focus on acquiring and retaining the right customers, driving share growth in our B2C and B2B businesses, and providing the best product and partner experience in the industry.
And Expedia also announcing a CEO transition plan and pause. Two other really interesting things. One, ARM adds $38 billion in value,
that's
a
real
record
money.
48% jump. And the S&P briefly broke above 5,000, guys. It didn't settle there, but it briefly broke above that for the first time ever.
Really?
Yeah, there should be balloons and confetti.
5,000.40.
We did
This is true. Yeah, but
it's a touch and go, right? Like that's all
it doesn't count though if it was intraday. Like we only count it when it's the close, right? You break out the hats when it closes above that level.
There's options tomorrow. It's going to move.
All right. We'll see whether
was this
we
one
get
of your
some
gainers,
momentum.
Carol?
Yeah. Okay. No. Let's get to some of the individual gainers. Surprise, surprise. ARM Holdings was a gainer, soaring to a record, up the most since its IPO last September. You know the news. You know the story. The company issued a surprisingly bullish earnings forecast, showing, and we've all had conversations about that, pushing beyond smartphones is helping fuel growth. So that was certainly a big, outstanding name. Another chip name on my radar, and this is Monolithic Power, say that 5 times fast, among the top of the NASDAQ 100. It's a semiconductor device company, reported fourth quarter results, beat expectations. It also gave a positive outlook. Analysts noted a tailwind from artificial intelligence. You had a lot of analysts raising their price. KeyBank, Cowen, Oppenheimer, Truist, all raising their price targets. KeyBank with a street high now of $8.30 a share, boosting it from a previous target of $600. But again, the stock up 40 47% by the close here. And then Disney, had to talk about it, rallying big time, most intraday or most in about 3 years since December of 2020. You know the story there, reported better than expected earnings for its fiscal first quarter, raised its dividend 50%, approved a $3 billion stock buyback plan, and issued an upbeat profit outlook for the year. So again, that one was up more than 11% in today's trade.
All right, well, let's look at some of the decliners as we continue to wait on earnings. Let's start with PayPal, among the worst performers on a percentage base in the S&P 500, sinking more than 11%, the most in months. This after the company issued a disappointing 2024 outlook. PayPal said it expects earnings to be flat this year as it continues to cut costs and streamline operations. Just a reminder, the company did announce last month it's going to cut about 9% of its workforce, part of the CEO's efforts to boost profits. Taking a look at Snap-on Tools, following the most intraday since March of 2020 after the company's tools group reported a sales shortfall. Management did say the segment's performance was, quote, not at our standard. Shares finishing down by 9.7%. And then, have you guys been talking about 23andMe much? The stock has been under a ton of pressure.
Tim has been talking about it a lot.
Right?
It's barely there. I mean, there are concerns that it's going to get delisted. Shares today falling for yet another day. The company CEO, Ann Wojcicki, telling Bloomberg News that she's considering splitting up the DNA testing company's consumer and therapeutics businesses in an effort to revive a sagging stock price and avoid being delisted, down another 13% today. Total return on the stock has been decline of more than 90%.
Have you guys taken one of those 23andMe tests? I mean,
No,
I feel
but
like everyone who was going to did it a few years ago.
That's exactly the problem. Right, it's not a recurring revenue business.
But they keep adding more people to the database. So then you can keep going back. So I haven't done it, but my husband does. He's totally into it.
Okay.
So he loves the whole, let's go back and then see if they've
But does
added
he
more
pay
people.
each time he goes back?
He doesn't tell me these things.
I do wonder, let's say the company is delisted, that's split up. I wonder what happens to the data, because a big question that I have is about the privacy of this data.
This is why I don't do it, because I don't want to share this information.
Yeah, that's a question that I have.
They already have all the data, please, from your smartphone. Anyway.
Stop.
Right? And just to pick a quick pivot here on yields, because we did see yields climb. We had that successful 30-year auction, but yields moved higher. We had a little bit of a sell-off, but not at all affecting the equity market. It does feel like we can have higher yields now and a higher equity market.
Yeah, it's kind of a ho-hum day in treasuries. I'm accustomed to seeing 23 basis point moves. So that's kind of shocking in how slow and boring it is. We have Take-Two numbers coming out. And Take-Two, of course, the video game publisher, everyone cares about it because of Grand Theft Auto 6 when that does come out. Not a whole lot of numbers to work on right now, but third quarter net bookings of $1.34 billion, slightly higher than what was anticipated, which was $1.32 billion. We're waiting for some more numbers to cross right now, but if you look at how the stock is trading in after hours, we have it closing up 3 cents at 169.60.
Up about 1%.
Like it's moving higher, right?
Yeah, it's just moving up a little bit right here. Yeah, this is a stock that I'm just looking at. It's up about 5% here so far this year, but again, you're seeing a little bit of momentum, up 2.5%. The company's saying it sees fiscal year net bookings of 5.25 to 5.30 billion. The estimate on the street, this looks a little light, 5.44 billion. And again, third quarter net bookings coming in at 1.34, a little bit above that estimate, Tim, of 1.32.
Yeah, shares of Pinterest, I want to go to those. They're getting crushed in the aftermarket right now, down more than 19%, down 20%. Fourth quarter adjusted earnings per share did beat estimates, coming in at 53 cents versus 48 cents. Fourth quarter revenue coming in below estimates, 981.3 million versus 990.2 million. Adjusted EBITDA coming in just above estimates, 364.8 million. Estimates are for 358.4 million.
I mean, they're looking for the first quarter of 2024, though, to be about 15 to 17% growth year over year, but that's kind of doing nothing for investors right now.
I feel like we got a sense that this was coming after Snap's results, which weren't that great either.
Yeah.
And the kind of move that we're seeing in Pinterest kind of mimics what we saw in Snap.
Like, I'll go to Pinterest, but I'm not going to buy anything on Pinterest.
It's becoming a tale of like two different types of companies, right? You have the Alphabets and the Meta platforms that are just dominating when it comes to social, when it comes to advertising, I should say. And then the ones that are the challengers, the Snaps and the Pinterest.
The big get bigger.
Yeah.
Right? Let's go to Affirm. That's a fun company to watch. It's a buy now, pay later. So Affirm, the one you want to pay attention to is their gross merchandise volume, and this is for the third quarter. That's how they do their fiscal year. That's coming in at the high end of $6 billion. billion. The estimate was for 5.89 billion, so a bit better than estimates. They see third quarter revenue on the high end, pretty good, coming in at 550 million. That stock, though, down by about 13%. Have to sort of dig into a little bit of why
it's now down
there.
about 20%. I'm trying to look through here on the press release, but that is pretty remarkable. As you said, second quarter revenue 591. That looks better than the street was expecting. Looking at the outlook, sees third quarter gross merchandise volume of 5.8 to 6 billion. The street estimate was 5.89. So there's got to be something here that is making investors kind of run for cover because it's down about 20%.
Yeah, the quarter that ended, the second quarter, revenue blew out expectations, 591 million versus the expected 520.7 million. So that's curious. We'll have to dig into that a little bit more. I guess people's expectations were just much, much higher than what we actually saw.
Yeah, a lot of stocks on the move, though. Affirm down 16% in the aftermarket. Expedia down 13% in the aftermarket. So we'll continue to track them here and look for some commentary on some of those calls. All right, guys, that's a wrap. A busy one across platform radio, TV, YouTube, and Bloomberg Originals. We will see you again, same time tomorrow.
All right, coming up, Jurrien Timmer, the director of global macro over at Fidelity, will be joining us. Alex has a lot of questions for him about all that dry powder on the sidelines and whether that's going to be put to work, and if so, where? This is The Close on Bloomberg. Big cap stocks in the U.S. finished the day little change, but the S&P 500 did trade above 5,000 for the first time ever. Alex, you pointed that out. It was a banner moment.
Yes.
Banner moment.
It was a banner moment.
But we didn't end there. And don't forget, it's gained about 14% in the past 3 months. So it's had quite the ride. This is, of course, a standard market cap weighted version of the index that I'm referring to. And that's heavily influenced by the moves of the mega cap tech stocks. However, if you look at the equal weighted version of the S&P 500, different picture, with the rally more or less stalling out this year. Jurrien Timmer joins us now. He is director of global macro at Fidelity. Jurrien, how much of what we're seeing in equities is determined by the volatility that we've seen in bonds?
Well, so the market, as you said, is making new highs and it has momentum, right? So the volatility has not been huge, but the momentum has been good. January is an up month. That tends to bode well. Of course, when the market makes a new all-time high after some sort of bear market or correction, the odds go up significantly of continued new highs. So momentum begets more momentum. But the indices that I really am looking at, and you mentioned S&P 500 equal, SPW on your Bloomberg, that has now been in a range for like 107 weeks. So we're still a few percent below the highs. But, I've studied this, and generally the generals lead the way, no pun intended, and the soldiers follow. And so typically, smaller caps go down more than large caps in a bear market. And so therefore they have more to recover. And so the Russell is still well below its highs. The SPW is slightly below its highs. MSCI All Country World is slightly below its highs. But once the generals are leading the charge, I think the rest of the market will follow. And I think it's just a matter of time before we are talking about new highs for all the indices.
So if I read between that lines, I should go buy small caps now, and I should go buy, materials, industrials, and energy?
Well, one of the good stories of this market has been that a lot of stocks have been left behind. I mean, that's not a good story, but for investors who may have missed it, right? Because
you don't want to buy tech here necessarily.
There's a lot of low-hanging fruit out there, right? So even the SP 500 equal weighted is trading at a 19 multiple. The Russell is trading at a 16 multiple. Ex-US, the world's trading at about a 14 multiple. Emerging markets at a 12. So there are a lot of stocks that are still somewhat uncovered. And if they do follow the generals, then I think that offers an opportunity. For me, the big question is not so much will they follow, but will they outperform? And that is a whole different question. And we've only had really 2 other episodes over the past century or so where such a small handful of very large cap companies have dominated. The original Nifty 50 in the 70s, and of course during the dot-com boom as well. So we don't have a large sample size, but last year only 26% of the stocks in the S&P outperformed the S&P, and that is the lowest on record.
Right, and this is something where we're all waiting with bated breath to see things broaden out. You're director of global macro, which means you pay attention to what the Fed says, how people are pricing in, what the Fed does next. The Fed has made it clear it's not doing anything in March, and maybe we'll get something in May or June. Until then, are we stuck with what we have here? Everything you just described, we're just kind of waiting, and eventually these things will happen, but something has to trigger it, and the catalyst is macro events. That's not happening.
I think the catalyst is earnings. So if you look at equity valuation, it's about earnings and interest rates, and then the risk premium, right, which is really a sentiment measure, or the PE ratio. And I think the Fed is correct in cutting rates some, but not too much. And my personal theory is that the Fed is trying to not repeat the mistakes from the 1960s. And it's a long time ago, but during the 60s, the Fed pivoted too quickly when there was a sign of weakness, because it was all about full employment at the time, less focus on inflation. And the Fed had to kind of walk back that rate cut in 67, I think it was, and then the great inflation had already been unleashed. And today, of course, we have a lot of fiscal stimulus, deficits 6-7%. Yep. And so my sense is that the Fed is going to err on the side of being more hawkish. And I think for the market, that's okay. I mean, the market has been pretty resilient. The economy has been resilient. And so the market has advanced quite a bit in expectation of an earnings recovery. I mean, the PE ratio in October 2022 was 15. Today it's 21. And so that's fairly normal, but those earnings have to come through. And of course, we're in the middle of earnings season right now. And so far, so good. And it looks like Q3 last year was the inflection for earnings.
So from what you're describing from the Fed, that's very much of a normalization process, in which case you can have relatively higher yields and also equities go higher at the same time in the same macro backdrop. Is that true?
Yes. So if you look at a discounted cash flow model, right, you have earnings in the numerator, interest rates in the denominator, and earnings are by far the more powerful driver of the two. I mean, last summer, when the bond yield was pushing against 5%, that was a pain point, but earnings were falling last year, and this year they're at least expected to grow about 9%. And so earnings are the dominant factor. But again, you look at that equity risk premium, right? So the bond yield plus the equity risk premium together make up the cost of capital, and that's how you discount future earnings to come up with a present value of those earnings, and that's your fair value valuation. And so the big delta here is that the equity risk premium a year and a half ago, or October of 22, was 5.7. Today it's 3.7. And so that's your swing of the market anticipating a lot of good news, and the market's pricing in both an earnings recovery and a Fed pivot. They don't tend to happen often at the same time.
That's right.
Correct.
How worried are you about events in the second half, the election, international crises worsening, and how early or how quickly should investors start positioning themselves, preparing themselves for that?
So there's always going to be geopolitical issues and headlines. I mean, it's sad to say, but that's kind of a reality, and there are always big things to worry about, and certainly this year is no difference. And for investors, you have to kind of cut through the stuff. I mean, it all matters, of course. There's human tragedies happening, but for investors, you have to figure out what is systemic to the markets, right? And then you come back to earnings, the economy, interest rates, and the market is weathering those storms pretty well. And then for the election, of course, this is a big one. I mean, they're always big, but the market's $40 trillion. The economy is $28 trillion, and the economy tends to be bigger than any particular election, which is not to say that the election is not going to have impact on sectors and policy and taxes and things like that. But the market tends to do what the market does, and the election tends to have less impact than maybe the presidential candidates would like to believe.
They always think they have a more direct impact, a direct hand and everything. Jurrien, thank you so much for joining us. Jurrien Timmer is Director of Global Macro at Fidelity. Coming up on The Close, we're going to talk about the top three. We focus in on the top three movers and shakers at the center of the day's big stories. Who's on top? That's next. This is The Close.
Crossed that 5,000 level for the S&P. We didn't hold there, but we did cross it. But then we got a slew of earnings, Scarlett, that came in after the bell. And some of them, like Pinterest down 15%, Affirm also down. Like if you miss, you get punished really, really hard. But on a headline level, we're there.
Yeah, Pinterest is interesting to me because even though its user base is fairly small, it's a read on the advertising market. And like Snap before it, the read from these smaller companies, these smaller platforms, is that it's not as great as what Alphabet or Meta would have you believe.
I mean, yeah, it's also true. Like it's easier to buy stuff on like Instagram than Pinterest, for example. But it is interesting looking at the S&P overall near 5,000 because tomorrow is an options. You do expire options on Friday. So trading around that's going to be quite interesting in any kind of follow through that winds up happening.
Maybe we'll see a pickup in volume because there wasn't a whole lot going on today. It felt kind of slow.
The whole week has been like that, actually. The low
Was there
volume.
too much focus on the bond auctions? Was that it?
Ha, ha, ha. I was into the bond
That's
auctions.
an inside
she
joke.
was not. And then now she's all talking about the bond auctions. Maybe they were all trading bonds and that was sort of the problem.
Okay, you talked about how there's a lot of earnings. I think we need to get a recap on all of that.
All right, let's do it. So Bloomberg's Isabel Lee and Emily Graffeo are looking into all these names. Hey, Isabel, kick it off.
Hey, Alex. So we have Pinterest shares falling as much as 16%. And up until today, the shares are up actually, but around 10%. But then we see that investors aren't happy with what they're seeing. We have fourth quarter revenue missing analyst estimates, and it follows its peer Snap, which is suffering from sluggish sales. So sales of the company rose 12%, but that's lower than analyst estimates. It did top projections for user growth. We have that hitting a record. It's been a tough time for Pinterest. Pinterest has been trying to shake things up, and they've done this by targeted ads, but that seems to be kind of in shaky grounds as well. But the company also focused on shoppable content, so we'll see how that goes. And here we have Take-Two Interactive. It's a video game operator, and shares are also down around 5%. The company narrowly missed estimates on its inline net bookings and badly missed guidance when it comes to its current quarter. The company cut its net bookings for the year, and also its guidance missed the average earnings estimates. The company said we are reducing our outlook for the year to reflect the tough macroeconomic environment. And shares are now down in post-market trading by 5%. What do you got, Emily?
Well, Isabel, I have another miss here on earnings in a stock in the red. I'm looking at Affirm Holdings, the buy now, pay later company. That stock is down about 6% right now in the post market. Not all the earnings were that bad. They had a beat on second quarter revenue coming in at $591 million versus estimates of $520. So that was a beat there. A beat on the third quarter revenue forecast. The EPS was in line. Exactly what's driving this decline in the post market? Perhaps it's a miss slightly on the gross merchandise volume forecast, but even then it came in at $25.25 billion versus estimates of $25.45 billion. So not exactly that much of a loss. Perhaps it was that the company was up 400% in 2023. Expectations were really high here. I'm also looking at a software company, Cloudflare. That was more of a beat in that stock, and we are seeing a big gain, 16%. There was a beat on fourth quarter adjusted EPS, a beat on revenue, and a beat on the adjusted gross margin. Scarlett and Alex.
Fantastic roundup of all the earnings after the bell. Emily Graffeo and Isabel Lee of Bloomberg News. All right, let's go now to the top three, where we take a deep dive into the people at the center of the day's top stories. And first up is David Einhorn. He is taking aim at regulators. The investor says the SEC has stopped policing corporate behavior unless a company files for bankruptcy. His take, Alex, if the SEC takes action against a public company, the stock might take a hit and the regulator could get blamed. And the SEC doesn't want that. It doesn't want to deal with that.
No, it does not want to deal with it. Also, he wants things easier. He just wants things a little easier. All right, well, I'm watching Jess Staley. It turns out the former Barclays CEO had plenty of contact with Jeffrey Epstein long after he said they stopped talking. According to legal documents that Bloomberg has seen, Staley and Epstein stayed in regular contact by using an unnamed intermediary.
It's pretty remarkable because Epstein would email this third party who would then verbally pass things on to Jess Staley, who would then give an answer back to the intermediary to pass on to Epstein. It's feels very much like high school, like writing a note and asking your friend to pass along to that guy during their free period.
And you do that when you're shy or when you're in class and you can, but if you're an adult and you do that, I don't know, don't you kind of know there's something off with that transmission mechanism?
And that might be the reason why this is such a fascinating story. All right, finally, our third person is Snoop Dogg. The rap star is suing Walmart and Post Foods, claiming that they conspired to crush his Snoop cereal. The cereal was intended to be a model for other minority-owned brands, and the names of these cereals, Fruity Hoops with marshmallows, Frosted Drizzlers, and Cinnamon Toasties. There's a lot of Z's in here that are not coming through as I say them. What he says Walmart did is keep them off the shelves at Post's instructions.
Well, I mean, there has been other accusations by other artists too of when they try and get into products that their stuff isn't promoted, like Diddy, Jay-Z. They had some sour joint ventures. So yeah, okay, the high-profile team-up might not work, but this has happened.
This has happened, and of course, Snoop Dogg will continue to watch for all of that, but some legal action on the part of Snoop Dogg and Master P. Coming up, which stock market was the first to trade online? We've got the answer to that coming up next. This is The Close on Bloomberg. Which U.S. stock market was the first to trade online? The answer, NASDAQ. NASDAQ, 53 years ago today, began operations. It was a system for stocks to electronically update their quotes and marked a distinct shift away from the traditional floor-based trading models of other exchanges. It became an established venue for many tech companies to get their start. You had Intel IPO on NASDAQ back in 1971, followed by Apple in 1980 and Microsoft in 1986. And in 1980, the NASDAQ became the first U.S. equities market to trade online. We spoke with the current CEO, Adena Friedman, back in 2016, right before she took charge. Listen to what she said.
We've been transforming NASDAQ into a global market technology provider or a global financial technology provider. And I will expect that I'll continue to take that journey with the clients and with our employees as we continue also, of course, to be a great exchange operator.
I didn't know that. That is terribly interesting. I totally love that. I love these questions.
What this day in history kind of thing?
I eat this stuff up. I don't want to come up with them, but I love being tricked into them and figuring them out. Okay, let's get to a stock that moved over the day, and that is Mattel. It ended up by about 0.3%. It released its latest results after the close yesterday. The company's sales jumping in the fourth quarter after the box office success of Barbie. Adjusted earnings and net sales did miss estimates. It is forecasting weaker demand for Barbie and its toys overall in 2024. Joining us now for more is Ynon Kreiz, the CEO of Mattel. Ynon, it's so great to chat with you. I'm very excited. Full disclosure, I was an enormous Barbie movie fan. Do you have to have a Barbie 2 and a Barbie 3 to make me keep wanting to go buy Barbies over the next 2 to 3 years?
Well, there's a lot to be excited about when it comes to Barbie, that's for sure. But before we dive in, just to give you a bit of context for the quarter and the year. This was a very strong fourth quarter for the company, with double-digit growth in top and bottom line and significant margin expansion. The year as a whole was a milestone year for Mattel. In addition to the incredible success of the Barbie movie, we extended our leadership in key toy categories and gained significant share overall, and continued to strengthen our financial position with over $700 million of free cash flow, which is more than 2.5 times that we generated last year. And in line with that, we just announced a $1 billion share repurchase program and believe we're in an excellent position to continue to execute on our strategy with Barbie and all of our other brands.
Okay, so let me ask you about one of your other brands, which is Fisher-Price. I know you're making some management changes for that division. What are your ambitions for the brand's future? And do you see it as a core brand for Mattel overall?
Fisher-Price had a very strong fourth quarter. It was up double-digit. It's the #1 brand in the infant, toddler, preschool category, and it continued to gain share for the year. And within that, Little People performed especially strongly with expanded adult collector line, including for the Super Bowl. So there's a lot of cultural touch points with that brand as well. In 24, Fisher-Price will expand its core product lines, enter a new segment. It will expand its licensed entertainment offering and continue to exit low-margin segments, which is something that we have been doing consistently. And that, in some ways, distorts the overall perspective around the brand because there are segments that we manage the exit of that brought the revenue down.
Ynon, what is not a core brand?
Can you repeat the question, please?
What is not a core brand right now?
Well, as a management team, we constantly evaluate our portfolio as a whole. We believe we have a very strong portfolio. but we constantly look and evaluate and measure our performance in order to create long-term shareholder value and position the company for profitable growth. And this is something that we do all the time as a team, and this is our expertise and what is behind the success of many of our other brands in our portfolio.
Activist investor Barrington thinks that Fisher-Price and American Girl may not be core and that you should divest. What do you think?
Well, without commenting specifically about any one brand, as a team, this is what we do. We constantly evaluate our portfolio. And in some cases, we have work to do, and we're doing that work. And as you mentioned earlier, in the case of Fisher-Price, we announced a leadership change a few weeks ago. We are looking to make more changes that we will be able to talk about in the upcoming analyst presentation. American Girl had some really exciting positive trends in the fourth quarter, and that brand as well is becoming now part of the North America business, so we can leverage our strong direct-to-consumer capabilities and our ability to create demand in a way that very few companies can do.
Okay.
So we have the capabilities and skills to drive those brands forward.
Alex brought up Barrington Capital, which of course is pushing for some changes. We also noticed, of course, is that you hired Christopher Farrell as Chief Strategy Officer, and he had an earlier career in M&A. So there are a lot of questions about what that signals, what Mattel is signaling about how you think through your portfolio, what's core, what's not, what should be built up further, what can be downsized a little bit.
Yeah, Chris Farrell has extensive experience in corporate finance, investment banking, corporate strategy, and M&A. And in line with our capital allocation priorities, we talked about investing in organic growth of the company, maintaining an investment grade and a 2 to 2.5 times leverage ratio, as well as M&A and share repurchase. And we think of these terms holistically. We just announced the $1 billion share repurchase program on one side. And on the other side, we continue to think about M&A opportunities that we're exploring right now, given our strength, our market leadership, our share gain, and our capital structure. We have optionality. When it comes to M&A, the criteria will be: is it additive to our strategy? Is it accretive? Is it holistic to our approach overall? And we're being very thoughtful, very disciplined, and very methodical about the opportunities we're looking at.
This is a funny question, but I actually kind of mean it. Do you need to have a Taylor Swift toy? And I'll just use my daughter as an example. She's 9. She doesn't want to play with Barbies anymore. But if you got her something Taylor Swift related, she would absolutely want to buy it and play with it. How do you bridge the gap of sort of the zeitgeist of Americana versus the products that you have?
Well, she might be one of the very few people who don't want to play with Barbie right now, because a lot of people do. But when it comes to our capabilities as a company, where we excel, one of our expertise is to create cultural moments and touch on societal trends that matter to the world. And we do that really well. We did it around the Barbie movie. We do it with all of our brands. And finding those moments, those key touch points, and taking brands that are timeless and making them timely is a core skill set that was a company. And you saw it in the movie, and you will continue to see that. And Taylor Swift, for that matter, is a great artist. And in my household, we have a lot of fans as well, Taylor. And we'll continue to find ways outside of the question to engage and collaborate with artists and role models.
So Mattel has plans for an American Girl movie. You're also, I understand, reportedly working with J-Lo on a Bob the Builder film. So you're leaning on that IP to continue to drive demand for filmed entertainment and bring in toy sales as well. Can you give us just a sneak preview of when we can expect some of these movies to come out?
Yes, we have a very exciting film slate, and it continues to grow. And what we're looking to do is to collaborate with leading filmmakers to make standout quality movies based on our iconic brands that will resonate in culture and appeal to global audiences. We haven't said when is the next movie coming out, but we have an exciting slate. We're collaborating with some of the most prolific filmmakers in the world, and we're going to share more along the way when these movies are ready, but it's going to be worth the wait.
Are you going to the Oscars, Inan?
I am. It's great to have Barbie in the running. We could not be more excited about Barbie and the reception that the movie has received, in not just in terms of box office, but also critically and by fans all over the world. It's exciting to see, and a great tribute to Greta Gerwig's vision,
absolutely,
and interpretation of the Barbie brand.
And Margot Robbie as well. She was a key part of that.
Margot Robbie has been a terrific partner, both as in front of the camera, but also as a producer.
Yes.
And we're very fortunate to collaborate with these talented filmmakers.
Inan, thank you so much for joining us. Inan Kreis is the CEO of Mattel. And of course, still bewildered why she didn't get a Best Actress nomination and why Greta Gerwig didn't get a Best Director nomination.
I know, but I feel like that perfectly encapsulates the whole point of Barbie. That's why, in my mind, the movie is so brilliant.
All right, let's, by the way, take a look at how markets closed on the day. 5,000. We got there in intraday trading. We didn't close there.
So it doesn't count. So according to Scarlett, that does not count.
Well, it doesn't count in the overall, did we close at that 5,000 level? No, we did not. 4,997 for the S&P 500. Barely any moves in the Treasury market, despite a fairly decent 30-year auction. The U.S. dollar levitates a little bit, up by 0.2%. And look at that, New York crude, Alex, up 3.5%.
Yeah, it feels like if we go towards peace in the Middle East or a ceasefire, that is negative for oil. If that's reneged in any way, it's positive for oil. I say that with skepticism because I don't actually know if that's entirely what's leading the oil market. But anyway, yes.
But there's a lot of supply. That's definitely what's
But that's
leading
definitely
the market.
there.
Yeah.
And then questions of demand, for sure.
All right, this is The Close on Bloomberg.
All right, you want to look at a winner? You want to look at a winner in today's session? Look no further than ARM. You had ARM Holdings surging as much as 64%. I think it added like, what, $38 billion in value after this record jump. Our AI helped bolster the chip designers' forecast. CEO Renee Haas spoke exclusively with Bloomberg's Ed Ludlow and Caroline Hyde.
This is really the results of strategies that were put in place a number of years ago that are now just really starting to come to fruition.
Yeah. When we think about the vindication, when we think, though, still about basically more of your technology going into more types of equipment, you've managed to see a diversification out of phones. Paint us the strategy of ARM going forwards, because many would say, actually, you're not just, well, the overall designer of chips, you're basically making the chips. You're fabulous in some way. How do you see that relationship going forward with Qualcomm, for example?
Well, a lot of folks, as you said, didn't really understand the company well and where we fit. And obviously, we had a lot of growth attached to the smartphone market. But ARM is in a lot of devices that people may not naturally think about. We're in a Tesla vehicle. We're in a Ford F-150. We're in a Ring smart camera. We're in a Samsung TV, a Samsung smart appliance. So just about every device you can think of has ARM inside. And just about every device you can think of needs more and more compute, particularly as AI is now driving a whole new demand cycle.
Talk to us about AI. Jeffrey is really singling that out, the analyst there, saying that this really shows you're a beneficiary from AI. But where does the AI focus come? You, of course, were at NVIDIA before. They are all about AI accelerators. And I'm interested as to whether or not that would be an area that you get into other than servers.
Well, right now, NVIDIA is a great partner. Their Grace Hopper chip, the super chip, uses a lot of ARM CPUs in combination with their GPU, which is a really, really great solution for high-end AI training in the data center, as well as inference. But when you start moving to smaller devices, say smartphones or PCs, well, AI is going to run there too. If you look at some of the recent announcements by Samsung and Google relative to their smartphones, there's a lot of things such as circling an image on a browser and then having that browser go off and do search based on the circle. That's AI. That's actually running in a smartphone. And what we're seeing is really a drive for more and more compute capacity to run these AI algorithms, some that people don't even know what they are yet. But what designers want to do and need to do is future-proof their designs with more and more compute. And that is really driving a strong licensing cycle for us in terms of more demand.
That was ARM CEO Renee Haas speaking exclusively to Caroline Hyde and Ed Ludlow of Bloomberg Television. And meantime, the Super Bowl is on Sunday. Alex Steele, you're actually going to watch, right?
We're debating. I am going to a Lunar New Year party on Sunday. Well, Saturday and Sunday, but on Sunday. But maybe there'll be the Super Bowl on while we have noodles.
I think that's a given. That's
it's supposed to be an anti-Super Bowl party, but I don't think that's going to actually happen.
All right. Well, Americans, maybe Alex as well, but anyone in the U.S. really stocking up for their game day spread. So here now to tell us what's on the menu is Jennifer Bartashis. She is senior analyst for packaged food and retail staples at Bloomberg Intelligence. Jen, it's great to speak with you. Give us just the first numbers that you guys have crunched, because certainly spending is going to increase. By how much, and what does that represent from last year?
Yeah, so overall, total spending for food and beverages for the big game are looking like they're going to be up almost 13%, up upwards of $8.8 billion. That's one of the biggest spending holidays, if you want to call it that, in the United States every year with regards to food. Within that category, snacks are really the shining feature. And because of the Taylor Swift effect and because of the people who are in the game, we're actually seeing snack sales going up nearly 14% to top $900 million just for this weekend.
Well, you mentioned the Taylor Swift thing. Does that mean that different people are watching it now that will have different snack preferences? It's not all like wings and beer?
Well, we're certainly expecting a larger cohort of younger viewers to at least watch part of the game. And we're attributing that to Taylor Swift. So in addition to the regular wings and pizza and things like that, we're expecting more of those snack food items because that does tend to be where the younger generation likes to nosh.
Yeah, definitely. I think about my son, and all he eats are those horrible Takis, which leave your fingers with all that dust.
Oh, gross.
It's like red and blue.
Not to mention like your gut.
Not to mention that. Talk a little bit about the most popular Super Bowl food. Alex is going to have noodles, she says.
Well, but for Lunar New Year, but
yeah, but I mean, she's going to have noodles, chicken wings, pizza, right? I mean, that's usually what we're expecting.
That's really where the largest sales are. Most of the planning goes in. I'm sorry, Alex, but noodles just usually aren't on the top of that list. But chicken wings, pizza, crunchy snacks, obviously soda, beer. Beer. Those are really the biggest sellers for this big game.
Okay, Jen. So on a company level, what am I buying in a Super Bowl weekend?
Well, in terms of the companies with the exposure, anybody who's in snacks. So PepsiCo, this is really a win for them. Between salty snacks and carbonated beverages, obviously Coca-Cola, any of your beer producers, and then on the protein side, companies like Tyson that have a wide variety of already pre-seasoned chicken products are probably set to do pretty well in terms of sales this week.
All right, Jen, thank you so much for giving us a sneak preview of what we can expect, what we'll be eating on Sunday. Jennifer Bartashis from Bloomberg Intelligence with her analysis on our spending habits on Super Bowl Sunday in preparation for Super Bowl Sunday. I want to go back to the broader economy for a moment here, because we did get some report on credit today, and credit conditions do seem to be moderating, and that is according to the latest Senior Loan Officer Opinion Survey. You like this news,
I love this news.
Okay, well,
I love this news because of this. Exactly what you're going to read is why I love them.
It's being actualized through a slight recovery in loan demand from both large and small firms, and that suggests that the majority of banks don't feel as exposed to mortgage loans. And this is exactly what lenders like One United Bank are really working to avoid. Founded in 1968, One United is the nation's largest Black-owned bank. It prides itself on giving its clients the tools to serve the Black community, creating generational wealth, and closing the racial wealth gap. Here now in studio, I'm pleased to say, to offer more insight is Kevin Cohey, Chairman, CEO, and owner of One United Bank, which has grown its assets to more than $650 million and financed almost $1 billion in loans. Kevin, so good to see you.
It's good to see you.
So give us a taste of what you're seeing right now in the economy, demand for credit from your customers.
Well, I think you see moderate demand. As you know, the high interest rates have dampened demand. And so I think I see it picking up a little bit is how I would describe it.
Have your lending standards changed? Like if demand's picking up a little bit, how are you looking at lending?
Well, from One United Bank's perspective, we do a variety of different types of lending. One big part of what we do is consumer loans. These what they call emergency loans that are in small dollar amounts for short periods of time. There's a continuous demand for that type of product. So you have to remember when you're talking about loans, they can be very different, and the demand for those loans differs for people in different circumstances.
Do you worry about commercial real estate? Are you exposed to that in any way, given what we've seen?
No, One United Bank is not exposed to commercial real estate, so we don't face that challenge. As you probably know, One United Bank operates on a national basis. And so a lot of things that we do are on the consumer side of the business as opposed to being on the commercial side of the business. So the loans that we call commercial loans are primarily multifamily housing that are designed to provide affordable housing to people. So that type of credit, the type of credit that we're involved in specifically, which people might call C buildings, there's tremendous demand. So you have to differentiate between the need for certain types of housing and the demand for certain types of housing and the various types of loans that are needed for various parts of the population, and that affects their demand.
You're serving your customer, and as we mentioned, your customer is the Black community, and you're the first Black bank to launch an AI tool as well to help your customer base really manage their money and understand their money. It's a real-time financial wellness companion. Can you tell us a little bit about Wise One and how people are using it?
Well, it's key. As you know, we live in a society where we forgot to teach financial literacy.
It's so true.
Let's just put it like that.
I didn't learn it until my 30s.
Well, and think about the impact that has on people. It would be no different than if we had not taught reading in schools. Well, guess what? If we didn't teach reading, we would have a bunch of people who couldn't read. Instead, what we have is a lot of people who are financially illiterate. And that's not any particular group. It's a pervasive problem throughout the United States for all income groups, the lack of being financially literate. The good news is what you just talked about is technology has reached a critical inflection point where the technology around data aggregation, the technology around artificial intelligence have reached a point where they could supplant people's knowledge. That's the whole concept of what we call artificial intelligence. Whether you use the word artificial or not, it's a form of intelligence. So it's created this unique opportunity in our society for people who haven't had exposure to financial literacy to all of a sudden become very literate. And so that's what Wise One does. It uses data aggregation technology to put together all the information on a person. So for many people, it's the first time that they really understand their financial selves. So they understand their revenues, they understand their expenses, they understand their surplus, they understand their assets, their liability, and their net worth. And most importantly, they understand how cash flows through their world. So you have this whole large groups of Americans who have no idea of what their financial situation is because their data is in all these different places. Suddenly it's all together and organized in a way they can see it. Then that's where the real magic comes in, because then we use our artificial intelligence technology to evaluate that information on a real-time basis and to give them insights as to what they should be doing financially. That's really one of the keys to increasing net worth. So we're part of this new generation of banks that create products that actually increase your net worth, as opposed to utilitarian products like checking and savings account, which help you to perform some specific function. Our products actually help you to build net worth, directly addressing these types of issues you mentioned, things like the racial wealth gap.
And clearly, you're really passionate about that. And I'm wondering if we just turn internally about the hiring practices. There's been a backlash against DEI for some reason, the SCOTUS ban on affirmative action. How has that affected how you hire and promote within the company?
It hasn't affected us at all. What is affecting us is technology and the opportunity offered by technology. You're in a situation, okay, banking as we know it it's shifted dramatically. We have went from community banking models to now you're going to models where, number one, people can actually bank from wherever they are. You can use your phone, you can use your computer, you have access to banking services 7 days a week, 24 hours a day, and you can spend money all around the world. So start with that, and then you have the creation of these new types of products that I'm talking to you about, and that creates this unique opportunity set, and that's going to help all of our society, not just Black Americans.
Kevin, appreciate your joining us today. Kevin Cohey is chairman and CEO of One United Bank. And that does it for us here on The Close. Balance of Power is up next. Have a great evening. This is Bloomberg.